starting off on page 1, which is RevProc 2020-25. And even though this RevProc is useless right now, because the effective date of this is you had to do whatever they had in here that they were allowing you. You had to do it by October 15, 2021, and that date is passed. The purpose of this RevProc was to give relief to those of us who have clients that had what is termed as qualified improvements. Qualified improvement is an improvement to the interior section of non-residential property. And the definition is under section 168E6. And without going into that too much, the old recovery life was, because that's non-residential, was 39 years. And they came in and they substituted, and by the way, they surprised the heck out of me. I never thought they'd do this. But they changed that recovery life for qualified improvements to 15 years. Now, when they did that, that sets off a number of items in the code that are kind of automatic. And one of them was bonus depreciation, which applies to any depreciable asset that's new or used that is 20 years or less recovery life, which means as soon as they change that for 18, 19, and 20 tax years, which by that time we were in the middle of the 20 filings in 21, by that time, 18 and 19 were already filed, and some of us already filed 20. And we had to go back on an amended return with this gift that they gave us to go back, and you had to do something if you had qualified improvements, because bonus is one of those automatics where the default is that you're going to take it. So if you buy an automobile and use it in your business, if you don't put an election statement to elect out of bonus, then you're deemed to have taken bonus, and you can't use standard mileage from that point on, because bonus is an accelerated method. And I like using standard mileage. It makes my preparation life easier. And I don't know what everybody is so big on, getting their deductions up front, because you don't get it up front, you'll get it at the end. You know, just think about it. Take a car. If you didn't take your bonus, and then you're a doctor, you have 80% business use all the way through. I don't know how that's possible, but when you sell it, whatever you didn't take up front, you're going to be deducting at the end. You get your deduction, you just have to wait a couple of years for it. And I know it's always, a couple of years is the time value of money, but I don't really like bonus, because it creates complications. The state doesn't allow it. So now right away, you got 2 depreciation schedule. And it's hell if you dispose of an item to try to get your software to handle the sale readily. So I may take it if I make a mistake, but generally none of my returns have bonus on it. And that's also because there are other ways to take the deduction, namely beat the betterment and restoration rules under the 263-3 regs, which we're going to talk about today, or take a 179 deduction or expense selection. So I will always take the 179 over the bonus, because bonus, if you take it, is 100% recapturable. 179 is not. Every year that goes by, I have less recapture. So I want to mention, I made a note on my copy, not your copy, of what this RevProc, as I talk about it, we're saying that we've automatically, by this change, been, I guess, given a gift that we could go back to 18, 19, and 20 under this RevProc And we could change the 4 elections under the 168K area. Actually, one of them's under 168G, electing the alternative depreciation life. But we could go back and change those. Normally, you cannot go back and change any of those elections. If you didn't elect out a bonus, there's nothing you can do after you file the return to change that. You're locked into it. And those changes are not, as they say, a change in method of accounting. Change in method of accounting means it qualifies for you to file a Form 3115 and go backward and clean things up.